Chapter 24, Installment Loans and Long-Term Debt.
Now, everyone has to borrow money at some point in their life. If they want to own a car, if they want to own a home, if they want to go to college and take student loans, or whatever. But the type of loan we're talking about here is different than a normal credit card type of debt. We're talking here about long-term liabilities, which means usually when you pay back a long-term liability, like a home mortgage or a car loan or a business loan, usually those loans are what we call installment loans. And an installment loan means that you pay the same amount each month until the loan is paid off. Now, when you take one of these loans for one of the reasons I mentioned, each equal monthly payment that you pay back is split into two categories. Some of each monthly payment is interest that the company that loaned you the money will keep forever as a service fee just for lending you the money. And any remaining amount of the monthly payment above whatever interest you owe for the month is the amount that decreases the balance of the loan. Now, that does seem a little bit complicated, but if you take a mortgage or a car loan or any other kind of installment loan, the company that gives you the loan is required to give you something called an amortization table. And an amortization table is a table that lists every future monthly payment that you're supposed to make in the same amount. And when it lists every single monthly payment that you're supposed to make, it clearly shows you for that payment, or rather for each payment, how much of that particular monthly payment is your interest expense that the finance company keeps forever, and how much of that same monthly payment remains to decrease the balance of the loan. So, when we do an example, we will give you the same type of amortization table that the lending company would give you if you had an installment loan. So let's imagine on April 30, Serena borrows $10,000 at the annual rate of 12% per year, and she's expected to make 10 equal monthly payments to pay back the $10,000. Now, if those were the terms of this example loan, this is what the amortization table would look like for those 10 payments. You could even use Excel to create your own amortization table so that you would know for yourself, under the specific terms of the loan agreement, how much of each monthly payment will be interest expense that the financial institution keeps as a service fee, and how much of the remainder of each payment will actually decrease the balance before you go to the next month. Now, I'm sure many of you have questions about how an amortization table is made. I can tell you that if you look in the description field below the table of contents, one of the links is a link to a video that will clearly explain all about installment loans and how they make the amortization table to come out perfectly, so that based on the terms of the loan, you have exactly the correct number of payments, the right amount of interest, and it will properly show you for each monthly payment how much is interest and how much decreases the principal balance. But this amortization table is what we will use in our first example to both borrow and experience recording paying back 2 or 3 payments of any installment loan. So how do we record the initial borrowing of the money? We use the deposit window. But before we can record borrowing the money and before we record paying it back, we have to create the proper accounts in the chart of accounts in order to be able to record things properly. So we have to add 2 specific accounts to the chart of accounts to be able to do this. First, we obviously have to record in our chart of accounts an account called Installment Loan Payable. And that will be the long-term liability account that we will record all transactions that relate to the loan. We will use it to record the initial borrowing, and every time we pay back, we will record the payment into that account, so that account will track the balance over time. We also need to add to the chart of accounts an account called interest expense. And again, since this is not a normal operating expense, we could choose to make it other expense or part of the regular expenses. I think interest expense could go in the same category as all the other expenses because it is a reflection of how well you're doing as you manage your business. But again, it will be up to you ultimately to choose what account type and what name to put in your own financial records. But let's go ahead and record these accounts in the chart of accounts. So of course, we always open the chart of accounts, and I like to click the cog wheel and go over to where it says chart of accounts. And then of course, we go up and click new for new account. Now you can pause the video if it takes you a moment to type in the name in capital letters, Installment Loan Payable. Now, as discussed, this is a long-term liability. And again, in this case, the detail type will not affect us, but let's do it properly anyway and call it Other Long-Term Liability. Then, I think instead of Save, you should click Save and New. This way, the new account window will stay open when we enter the interest expense account. And we go. Now, this, of course, is an expense, and I would not put other expense. In my opinion, interest expense on a loan that you take for things that you need for whatever, whether it be operating or doing your business, is not other expense under the operating income. In my opinion, it's a normal expense, but you'll decide which position in your profit and loss you would like this to appear. And of course, the detail type won't affect us in this case, so let's just put other business expenses. And then, of course, we can click Save, and the window will close. And when we choose only the accounts created by us, you can see we have the installment loan payable on the list. And if we go down here, we have interest expense, and now we're able to record transaction for the long-term liability installment loan. So again, let's imagine on April 30, Serena borrows $10,000 from the very large Corporation of America lending company. You can add that name on the fly. And let's imagine the money gets directly deposited into her Chase Bank. Don't forget the terms are 10 equal installment payments at the annual rate of 12% interest. We're going to use the amortization table when we make payments to pay it back. But when we record the initial loan, it should be as easy as any other transaction. Now, of course, the $10,000 that she borrowed got deposited into her Chase bank account. So it's the Chase bank account register that will open. And this is a deposit on April 30, 2026 is our little story. Now, the account, of course, will be the installment loan payable account because that's the reason for it. We created it to track all the transactions and the balance of this particular loan. Now, the people we borrowed it from are not yet on the vendor list, but they are providing a service. So they are vendors, and they are they're the people we borrowed the money from, and we're going to be paying it back. Click Save. So now we have who and why and when. Now this is a deposit going into the bank account for the $10,000 that Serena just borrowed. So 10, tab. And of course, if we save it, we already know what will happen in the trial balance, but let's confirm and take a look. If we click Reports and we open our good friend, the trial balance, you can see installment loan payable shows up for the first time as $10,000, and you can see the bank account has increased by $10,000, exactly what you would expect. Now, of course, if we borrowed the money on April 30, it means the first monthly installment payment should be on May 30th. Now, here we are looking at the amortization table that will tell us all the information we need to record the first monthly payment. So let's take a look. We see that every monthly payment will be the same, $1,055.82. But if we look at only this column, we can see the specific numbers that we need to record the first monthly payment properly. Notice that even though we're paying $1,055 every time, for the first payment and only for the first payment, the amount of interest is $100. That means that the rest of the $1,055 will reduce what we owe. They get to keep the interest forever as a service fee for lending the money. But if we pay more than the service fee, whatever extra we pay decreases the principal balance. So if this is the amount of the monthly payment, that means that this will be the amount here that we reduce the principal by, which means after we record this first payment, the balance will decrease, but the balance will not decrease by the $1,055. It will only decrease by the $955 here, and according to this table, it should be $9,044.18 when we finish our first transaction. Let's take a look at how to record it. Now, because there's more than one account changing in this transaction, it's best to use the expense window rather than the register window. So we go to the top left and click New, Expense. And of course, the date of this particular expense is May 30th of 2026. We're paying the very large Corporation of America lending company, the people who were kind enough to lend Serena the money in the first place, and we're paying from Serena's Chase bank account. Now, of course, normally there'd be a reference number, but the most important thing to concentrate on in this particular transaction are the two accounts. First, we have the interest expense that's specific for this month. And if we go back to the amortization table, it says for the first payment and only for the first payment, the amount of interest expense is $100. So that's the amount we're going to put on the same row as the interest expense account. Now, the rest decreases the balance of the installment loan payable, which goes on the next line. Watch carefully. The amount the balance is being reduced is $955.82 for reasons I just explained. $955.82. Notice the entire amount of the payment is $1,055.82, which is exactly what the amortization table wants us to put as the entire payment. And after we save it, this amount, $9,044.18, should be the ending balance according to the amortization table. So when we click Save and Close, we can open the trial balance and zoom in a bit and see two important things. First of all, the interest expense showed up for the first time in the amount that we recorded, $100. Secondly, the installment loan payable balance is now $9,044.18, which is exactly what the amortization table says it should be after the first monthly installment payment. So now let's do the second consecutive monthly payment, where we will pay it on June 30th. And when you take a look again, we see that this column, the payment column, this row, the payment row, tells us for every monthly payment exactly what the amount should be regardless. But we don't put it in that way. We look specifically at the column of payment number 2, and we see that the interest expense for payment number 2 will be a little bit smaller, which will make sense because the amount of the balance after payment number 1 is lower. So if you owe less money at the end of this month, the amount of your interest expense will be less at the end of this month. And again, if we're still paying $1,055 here, and they only get to keep for themselves $90.44, that means the rest of the $1,055 decreases what we owe, and this will be the principal reduction when we record this second monthly payment. And we use this column to do it. We go back to QuickBooks and click New, Expense, and this time the date is June 30th in our little story, and we're still paying the same people whom we borrowed the money from. Click No because the numbers are, by the way, when you get that message, always click No because the numbers will almost always be different when you're paying the same vendor a different payment. So normally there'd be a reference number, but again, we're focusing on the accounts, and the interest expense in this second monthly payment, the amortization table tells us to use $90.44. So we put in the amount $90.44. That means that the installment loan payable, which is the account that tracks the balance of what we owe, will decrease by the amount the amortization table tells us to in the second monthly payment, which is $965.38. So $965.38. Notice again, the total amount that's coming out of Serena's account is $1,055.82. But this time, this is the amount of interest, and this is the amount the loan payable decreases. When we click Save and Close, we can open the trial balance the way we normally do and zoom in the way we normally do, and we can see that interest expense has here it is, $190.44. That's the $100 from the first payment and $90.44 from the second payment. But look at the balance of the installment loan payable, $8,078.80, which is exactly the amount that the amortization table says that we owe after the second monthly installment payment. And of course, if we double-click Serena's bank account, we see that the last two transactions were the last 2 monthly payments we made to the loan, May 30th, June 30th, to the same company, and it was the same amount for each of the monthly installment loan payments.